Hi, everyone. Thanks for joining me on this webinar today. Today, we'll talk about how to do due diligence for healthcare startup. This will be a short presentation followed by a conversation with our guests, Lu, Zhang, and Shubhra. I'll be talking about what I look for in the team, the product, the market, metrics, and the regulatory framework I look at. If it's your first time investing in a startup, generally, I would advise you to have a screening criteria. My screening criteria is fairly simple and it's mostly based around the team. The founders must have known each other ideally for more than 6 months. It's better if they worked together in the past, and they must be full-time in the startup, either at the type of investment or shortly thereafter. I'll make some exceptions for clinical founders if their clinical role adds value to the startup, but even in that case, the majority of their time commitment and capital commitment should be towards the startup, because it's so difficult to grow a startup, and there's so many ups and downs. Commitment to the problem they're solving and commitment to the startup is critical. If they pass the screening criteria, I'll ask for their deck. I'll go over what I look for in the deck, but if I am interested in what their deck says, I'll meet with them. After I meet with them, I'll think about the meeting, I'll reflect on it, I'll do some more research. Generally, when people talk about problems they're solving, they're making a bet about the future of healthcare. And I need to ask myself, am I comfortable with the same bet? So AI is a great bet a lot of people are making right now in clinical decision support tools, in replacing or helping our workflows. And my thinking on this is AI will help with patient engagement and help with clinical workflows. I don't think it will replace our decision making in the next 5 years. Again, the time frame for venture and the time frame for early stage investing, if you're an angel investor, is generally you want returns within 5 to 10 years. So sometimes you'll see startups that are way too early for their stage, and if you don't think they will come to market, and if you don't think they will get market adoption within 10 years, at least for venture capital, it doesn't fit the framework. After the research, I'll do deep due diligence. I use my network to do diligence in different aspects. And if I'm still interested in the startup, I will go through the legals and do reference checks. Reference checks are critical. Generally, a reference check with a previous investor and 1 to 2 customers is important. If there's anything I want you guys to take from this talk, it's having a decision-making framework. It's having a balance of intuition and structure. Usually, it's good to have a structured approach and use intuition at the end. I don't invest against my intuition, but I don't rely solely on my intuition for decision-making. Thinking is a very taxing endeavor. We don't think of thoughts and thinking as energy expenditure, but a chess player burns about 6,000 calories a day, a professional chess player, whereas a marathon runner will burn about 2,600. So you're burning twice as many calories thinking than you are playing chess. Be wary of your biases, of assumptions you're making. A good framework for this, I like Danny Kahneman's framework of when to use your intuition and when not to. Essentially, he says, if you're an expert in something and it is a high validity environment, so a high validity environment is an environment which is somewhat stable, you're doing an action repeatedly, and you know if you're right or wrong fairly quickly. I'm a physician, so working in urgent care is a high validity environment. Investing is a low validity environment because after you invest in a startup, we don't know if we're doing well really till exit, which is in healthcare generally a minimum 5 years. So it's important to have a structure in place. That being said, within the structured process, you can use intuition if you're an expert and it fits that high validity framework. So what do I look for in a team? The 2 main things I would say I look for is founder problem fit and team dynamics. Why is this founder working on this problem, and why will they stick with this problem? Why will they continue to iterate on their solution until they find product market fit? I look for founders who have a story. I ask them how they became familiar with this problem, and then I just go deeper into, why are you working on this? Why aren't you working on something else? Why aren't you working on something easier? Healthcare is a very difficult industry to break into. I look at team dynamics. I want to know the team has somewhat of a history. They'll stick together. I want to know every co-founder has the founder problem fit. So I speak with all the co-founders. Mark Andreessen famously says, strong ideas loosely held. There is a balance of humility and conviction. So you need to have the conviction that your solution is a solution that will solve this massive problem you're trying to solve. You also need to have the humility to pivot when you're recognizing you're not meeting your metrics or whatever metrics you have where your solution isn't working. Which is why, again, founder problem fit, commitment to the problem you're solving is important, because you will continue to iterate to get product market fit or founder market fit. I am not too keen on founder market fit. I know other investors index founder market fit, previous exits very heavily. I don't. There's very few founders who have 2 unicorns, especially within one industry. There was a Harvard study in 2004 that says you have a 30% more chance of success if you're a previous founder. But, that leaves a 70%, which you don't need to be a previous founder. And ideally, your previous exit, if we are sticking to data, should be a small exit. That's when you still have the hunger and you want to do something big. So in terms of product, the founder has to be problem focused, loosely held strong ideas, and customer obsessed. They should have an in-depth knowledge of their product, but they need to be focused on the problem they're solving. A scalability roadmap is important. How will this scale? Early stage investing, following the power law, is a game of outsized returns. It's a game of maximizing your upside while essentially not worrying too much about your downside. What that means is the startup must grow to immense revenue. Usually when I invest, either they don't have revenue or they have a couple $100,000 in revenue. I need a path for them to grow to at least 50 million, if not 100 million in revenue. And they need to show me what products, what other verticals we're going to go into, other products we'll make, or just the product they have right now. How will this scale to bring that revenue? Idealab did a study in which they were asking what is the biggest predictor of startup success. If you ask first-time founders, they will often say their product or their team. If you ask second-time founders, they will usually say distribution or how will they scale. What this study found is why now. Is the market ready for your product? There's a startup in the 90s that made the iPhone before the iPhone came. There were tons of different versions of Instacart before Instacart. There's countless examples of startups that were too early for the market. The infrastructure wasn't there. People weren't ready to pay for it. Google was the 17th search engine. So, is the market ready for your product? Are people ready to pay for your product is important. Identifying market tailwinds is critical. And this is why so much money is put into market research. Some market tailwinds I'm banking on is a digital front door hybrid home care model, AI focused on patient engagement. And in the near future, I think patients will make their own clinical decisions with the help of AI. Now that requires reimbursement and regulatory changes, which I'm banking on. But essentially you're making these big bets, and that's how you get these outsized returns. And especially if you're making bets that other people are missing. Now you need to have conviction in your bets. You need to have substance behind it. You need to have done research about, okay, how were the previous tailwinds and why am I predicting this one? Most tailwinds are not predictable. So COVID, is a perfect tailwind. It flew a lot of startups to success. We're not doing so well right now, but strictly from an investing perspective, you get your money out on exit. So, you can't predict COVID, but there are other tailwinds, like when will AI reach adoption in healthcare? Is there precision medicine? Will it play a big part? Will epigenetics play a big part in medicine? And again, stick to the next 5 to 10 years. We can all say maybe we will live in the metaverse, but if you don't think we will live in the metaverse within the next 5 to 10 years, I would advise staying away from investing in it in the venture model. If you're an angel investor and your timeline is 50 years, sure. I think you can take a longer timeline approach to investing. So So I look at the business model in general as a B2B, B2C. There's pluses and minuses to both. B2B is longer sales cycle, but the contracts are stickier. B2C, it depends if you're competing on price, it's very difficult, and it opens the door, or the door is open for others to kind of just drive their price lower. And you don't want to be a loss leader in a market. Competing on value is much better, and I think lots of people who are much smarter than me have talked about this, so I'm not going to get into too much. But essentially, do they have a scalable business model or profitable unit economics? Is their customer acquisition cost going to go down? Are they having more organic growth? What's their cost of goods, and will it go down? And cost of goods essentially is, how much does it cost to make your good or your product? Competition, startups should have a deep understanding of their competition. Why will they win? Do they have better product? Do they have better distribution? What is their differentiator? I don't worry too much about incumbents, Google, Microsoft, Amazon, stealing their idea. It rarely happens. And generally, there's a competition between the startup getting to distribution before one of these incumbents, if they think this idea is valuable enough, the market is big enough, and they want to devote the resources building their product. Generally, the startup will win, I would say. But again, it's a good question to ask, but I don't index why won't Google do this or why won't Amazon do this too much, unless they're building something that directly competes with what the incumbent is doing at this point, or that they plan to do, and the public said so in the next year or two. So traction is incredibly important, and it essentially validates all the hypotheses that the founders are making, all the assumptions they're making. Ideally, they validate before they build, and then they start selling their product in some capacity while they're building. This is more of a mindset. I just want them to value the sales process and not just the product process. If you build it, they will not come. You have to sell it. You have to have a sales marketing strategy in place. Branding is incredibly important here. Some metrics I look for: what is their run rate, which is how much money they're making, what's their burn rate, how much money are they spending, what's their LTV to CAC ratio. LTV is the lifetime value for customer, CAC is the customer acquisition cost. A ratio of 3 to 1 or higher is good. In terms of legals, I won't go into too much depth here. The main thing is the cap table, which is the breakdown of who owns what in the company. At my stage, the founders must have at least 60%, if not 80%. And this includes employee stock option pool, which is some equity set aside for future employees they bring on as the company scales, usually 10 to 20%. They should have some intellectual property. Defensibility can be in the distribution, but for biotech, medical device, I want to know why is this different from other startups in their space or from people who have done this in the past. And the difference could be that now is the right market timing. But I want to know why is not the right time and what's different about you. All equity for the founder should be vested, which means they're given the equity usually over 4 years, sometimes 6 years. And there's a 1-year cliff, which means if they leave before 12 months, they don't get any equity. What you'll see often is they get 25% after a year, and then the remaining 75% over the next 36 months. Which is standard. I'm happy with that. I'll speak a little bit about regulatory. There's 3 classes the FDA uses: class 1, 2, 3. Class 1 is low risk, class 3 is high risk, class 2 is in the middle. If you're investing in medical device, most startups will fall into class 2, and either they will say they're de novo or 510K. Again, most will be 510K. 510K means that there's a predicate. Someone has done this before and they're using their FDA approval to piggyback on. Now, if they're using a 510K, I would ask them, well, why are you different? Why didn't the previous one succeed? Or if they succeeded, why will you succeed if they're the market leader currently? In terms of how much it costs to go through FDA approval, including clinical trials, and how long it takes, de novo, I would say 3 million, 3 years, 510K. 5 million, 5 years. Class 3, you need massive clinical trials, pre-market approval, tens of millions, 8 years or so. And again, there's a lot of variance there, but that's in general. So, in brief, use an intuition guided structured decision making process. And we'll get started with our questions and answers now. Thanks, everyone. Okay, Lu, we'll start with you. So I have a few questions in mind, and then we have a few questions from our audience as well. Can you give me your thought process on the role of structure and intuition in your decision making process for due diligence? And how do you know when to trust your intuition and when not to?
Yeah, so we have a pretty comprehensive methodology of doing the internal due diligence. I think if we really just try to think from the high level, the first is really just look at the sector we focus. The sector we choose to invest is really based on the strong conviction we have and also the expertise we have. So based on that, we start to looking at a company, go through different screening process, and eventually go through due diligence. Our procedure start with the initial screening meeting call, which is like 30 minutes, because before that, we'll definitely look at the deck, make sure it's a good fit for the fund. I think the quick 30 minutes, for sure, we won't be able to know everything about the company, but be able to capture the key message in order to do a quick yes or no, what is a good fit for us. I think for most of time, in terms of fundraising and the due diligence, is really about the matching. It's not about what the company is perfect and no risk, and there's no way, any early stage company has a risk profile, and no company is perfect. But it's really about matching between what investor looking for and what founder is looking for. So that's how we do this first, a quick 30-minute screening call. After that, if team feels strong, they will bring to our partner pitch meeting where the whole Fusion team will be there to spend 45 minutes to 1 hour with the founder, to really dive into the details and also be able everyone share a different perspective, look at whether it's a good opportunity for us to explore further. After that, that'll be due diligence. So it's not like a meta company do due diligence right away. Before due diligence, yeah, so we have a pretty comprehensive methodology of doing the internal due diligence. I think if we really just try to think from the high level, the first is really just look at the sector we focus. The sector we choose to invest is really based on the strong conviction we have and also the expertise we have. So based on that, we start to looking at a company, go through different screening process, and eventually go through due diligence. Our procedure start with the initial screening meeting call, which is like 30 minutes, because before that, we'll definitely look at the deck, make sure it's a good fit for the fund. I think the quick 30 minutes, for sure, we won't be able to know everything about the company, but be able to capture the key message in order to do a quick yes or no, what is a good fit for us. I think for most of time, in terms of fundraising and the due diligence, is really about the matching. It's not about what the company is perfect and no risk, and there's no way, any early stage company has a risk profile, and no company is perfect. But it's really about matching between what investor looking for and what founder is looking for. So that's how we do this first, a quick 30-minute screening call. After that, if team feels strong, they will bring to our partner pitch meeting where the whole Fusion team will be there to spend 45 minutes to 1 hour with the founder, to really dive into the details and also be able everyone share a different perspective, look at whether it's a good opportunity for us to explore further. After that, that'll be due diligence. So it's not like a meta company do due diligence right away. Before due diligence, there's a couple different process we need to go through in order to be cautious and be efficient with each other's time. So look at due diligence. As I said, what is venture capital firm are doing? We're evaluating risk level to see whether we could take the risk to investing so early, because every company has certain risk level. It's just that we also equipped with not only money. VC is never only about the money. VC is also about resources, connection, domain expertise. For a certain type of company, maybe risk level on certain market size will be higher for others. Maybe for us, we could handle it better because we know who we could talk to and what resources we could bring into the company. So being said so, we still need to evaluate overall risk profile. We start with market risk. Market risk looking at first market size has to be huge enough, right? And also market timing has to be right, because market timing is something out of everyone's control. AI has been there for like probably 40, 50 years. And it's until now we see the market timing is not coming. It's not only technology is ready, it's also industry mindset is changed and also is ready. So market risk is the first one. Second is technology product risk. Look at technology itself. We don't invest in anything consumer, we invest in healthcare, enterprise network, and industry automation. So technology component is very important. That's also part of their differentiation. But on the other side, Market doesn't need the best technology. Market need better, faster, cheaper technology and the product. How to really find that aspect from the company we're talking to, that's important. The third one is definitely team, the founding team. We're looking at founder from all different angles. It's not about who is the smartest one in the room. It's really about founder first, whether they have a clear vision and the unique insight about the industry. Second, strong leadership means they could attract top talent to join in this smaller startup. And third is really resilient. Market is crazy. Every company gonna go through upturn and downturn. The founder who could be the survivor is the one who have a strong persistency, be able to have strong resilience to go through different market cycle, and the survivor gonna be the winner. So there's lots of other things we need to do to evaluate the founder, but this is the three key thing. After that, not finished yet, execution risk, the go-to-market business model, everything. That's how to execute it. After that, competitive landscape, whether there's a crowded market, which might be a bad signal, or whether there's nobody in the market, means you might be too early for the market. And the last one is exit risk. When we invest in company, even at such early stage, we need to think about exit from the beginning. What is the potential for exit size? What is the potential channel for exit? Merge acquisition, IPO, how long would it take? What did it go along together with our expectation of the founder? So you can see all of this together. It's just the core we need to do in terms of due diligence. Beyond that, there are lots of reference check, legal, financial. So people always misunderstood early stage investment is easy. Actually, no, it's really hard to make a decision to make an investment. Also, because we don't have too much of financial data, we actually need to do even much more work to due diligence on non-financial aspect to make sure this is a big potential startup going to take off in the near future.
Thank you for that very informed answer, Lu. Shubhra, I'd love to get your thoughts as well on your diligence process, intuition structure, and how do you know when to trust your intuition?
Yeah, I think Lu was pretty comprehensive in terms of the different buckets that you look at and the boxes that you need to check as you're going through the diligence. Maybe I'll take a little bit of a different approach and sort of talk about the balance between structure and intuition in each of those buckets. So starting with market attractiveness, and that includes market size and structure and various competitors that are currently playing in the market. And some of that is analytical and what I'll say quote unquote knowable, and that's the structure part of it. Have you done your homework to understand what is your available market, what market can you potentially expand into in the near term, and what it would take to do that? Who will you be going up against in terms of competition? What leverage do they have over you currently? How will you overcome or perform despite that leverage? But then once you have known all of the knowable stuff, that's where intuition comes in as an investor, where you have to some degree, you have to believe that the adjacent markets will pan out, that they will be able to expand in a scalable and financially viable manner to a bigger market than where they're currently playing, that they will be able to sustain any competitive advantage that they currently have, and also continue to build competitive advantage over time, because competition, you can never think too broadly about competition. Just because someone is not playing in your market today doesn't mean they will not tomorrow. There will be new companies starting everywhere in the world that you are not aware of today, that don't exist today, but will start over the time that you will build your business, and will expand into the areas that they may currently not been operating in today. And how do you intuitively think about building and sustaining a competitive moat? So that's where the intuition comes in. Same thing with team. Team is absolutely one of the most important things, especially in early stage investing. And as Lu mentioned, it's very critical that the founder has the ability to roll with the punches, right? To be able to handle the unknowns. And there are some things that we can look for in a more structured fashion in terms of founder market fit. How deep a knowledge that do they have of the problem that they are solving? Do they have sufficient technical expertise? And do they have sufficient people and talent to augment them on things that they don't know? What is their general level of great determination, perseverance that they have demonstrated in their career and their life so far? But then there is a lot that is intuition, and that's where you have to meet the founder and sort of believe in their ability to handle what you and them both don't know will be presented to them as they continue to build the company. So you start with some structure potentially, but very quickly and in a very, very significant and material way, you have to trust your intuition in order to believe that this is really the best team to capitalize on this market opportunity. Same with the financials. I would say that albeit a little bit less important in early stages because many companies will not have well-developed financials, but even them having a thorough understanding of what the financial model of the business looks like, how is it expected to scale. But then the place where intuition comes in is the believability part of it, right? Like you can use structure and analysis to understand everything that the founder is communicating to you, but what do you believe based on your experience in the industry, based on what you've seen play out? What are the threats and risks that you can perceive to that model playing out as it is being presented today? And that's where intuition comes in. So they go hand in hand really through every step of the process. And I would say every investor, when you start investing, we all have a learning curve, and we start with structure and we develop intuition over time. As we become more experienced, intuition helps us overcome some of the structural analysis paralysis that we go through in the beginning of our career journeys as an investor. And it's just years of condensed structural thinking that learns to play as intuition and is accessible to us when we're making investment decisions as we have gained more experience.
Perfect. Thanks for that answer, Shubhra. Tim from Icona Health asked an interesting question is, how did you get to conviction on your last deal? Lu, could you answer that question first?
Yeah, good questions. We're recently just an investor company. The conviction on one side, definitely there's lots of logical analysis based on the due diligence process I just mentioned. But, early stage investment is never about 100%, logical analysis, because no matter how much research we did, we couldn't cover 100% of all the information. I keep telling my team that sometimes most of the time we're making the final decision based on incomplete information. No matter how many projections we could do, that might be wrong. A couple years later, you look back, maybe founder gonna pivot to a different direction sooner or later because this is an early stage company. So I think conviction is really eventually foundation of like whether we see a huge potential coming out with the industry we're focusing on, whether we have a strong conviction on the founder are the right people to make it happen, and also the product technology itself have unique differentiation. So I think this is a couple things be able to help us build a conviction. And also meanwhile, all this like due diligence is more about first layer is serving the purpose to check there's no red flag. And second, and also provide lots of data and the supporting evidence to really show that, okay, our convictions is right. So I think this is definitely a long process, including lots of reference check going on. But essentially the thing I mentioned early on was the fundamental, and all the rest of the due diligence reference check was the thing to help us just the double checking on whether we're making the right decision.
Okay, perfect. I have a million questions for both of you, but Shubhra, if you could answer that question, and we'll take some questions from the audience.
Yeah, I think you said it, Rashad, earlier in your presentation. At least on the last deal, our conviction was heavily predicated on the answer to the question of why now. The company we invested in was at the intersection of healthcare and AI, and helping with physician burnout, helping with squeezing revenue streams of health systems and hospitals. And we just saw all of those trends coming together. The technology is finally there with all of the advancements that have happened in AI in the past year. The data is finally there with so much structured and unstructured data being available since the start of electronic medical records. The talent is there with so many engineers and ML application scientists coming out of some of the greatest universities of the world. And the problem has never been bigger. The opportunity space is big and wide and open for someone taking it on, because hospitals and health systems are operating at very thin margins, especially recovering since they lost huge revenue streams during COVID. And physicians are burned out with all of the documentation that's going on. So we did all of the diligence steps and checked all the boxes in terms of doing a market analysis and competitive analysis and reference checks and all of that. But really what got us over the line was the conviction in the fact that the time is now, and this is a team that is well suited to capitalize on this opportunity at this moment.
Perfect. I think I completely agree. AI in healthcare is a booming space right now and a massive tailwind to invest in. I'll ask one selfish question and then we'll go to audience questions. Lu, how do I perform good reference checks? Who do I talk to? What do I ask them?
Typically for investor to do reference check, a couple reference. First is reference about founder themselves. It's like a personal reference check. Better to be someone you had a working relationship before and also really know you very well. And the second is really just a reference check on the customer side. Lots of companies saying that we're in conversation with this customer. That's the one showing that we can have market validation of the product. And the last one is a reference check with your existing shareholder, your board member, to understand the past experience of them working with you. That is the kind of major type of reference check when happen. I think first, you definitely want to find the right person to talk about in greater details, be able to provide example of how you guys work together. Second, I would highly recommend still, even you think, okay, my friend like Bob is like awesome, but still give them a heads up and also some general guideline that, okay, this is a investor going to reach out to you. I think they're probably most interested in how we interact on certain type of project. Then they know how to do the reference check for you, because sometimes I found founder, they didn't prepare their reference, and later the communication might not be as ideal as them. But on the other side, I also want to be honest, because it's very easy for investor to tell whether this is an honest reference check or just a sugarcoating things. You also don't want people who do reference check for you only say good things about you, only say you're perfect and everything you do is perfect. It's just superficial. It won't really serve the purpose. I think for reference check, we also further validate the risk level, because to a certain extent, when the due diligence process move forward to reference check means most likely this investor want to invest. So they're trying to check whether there's any red flag. And meanwhile, want to also understand, okay, any other risk factor I haven't taken into consideration. So typical questions for them, we would ask, oh, what is your suggestion to the founder for them to continue work on that? They could do better in the future. That's not the best thing to give honest conversation and honest answer, because then the new investor will know which part they could focus on to help founder to grow. Instead of saying that, oh, this founder is perfect, nothing they need to work on. That will still go back to what I said. It will be superficial, basically waste the opportunity for one good reference check.
Shubhra, I'll ask you a slightly different question. Can you, if you're able to, tell me about a time where you could sense someone was sugarcoating things, and how could you tell? And as building on Lu's point, you don't want to say the founder is perfect, but you also don't want to give a weakness like the founder is lazy, because that is a very bad weakness to have. So how do you go about figuring out, are they sugarcoating things? Are they not being earnest and forthcoming? I'd love for you to tell me about a time, and then what is a good weakness, you would say?
What is a good weakness? Okay, I'll think about that. Well, so it's very, as Lu is saying, it's very easy to tell when people are sugarcoating and not being forthright. And to be honest, it's less common than you would think, especially when we're calling up somebody who was a board member or an investor or a previous employer. I think people generally care quite a bit about their own reputation in the industry, and people understand that this is a multi-step game. This is probably we're probably going to have multiple interactions over the course of our careers and lifetimes, and they don't want to risk and they shouldn't risk their reputation by giving a false reference or hiding things or sugarcoating things. Now, that said, as human beings, we also tend to not want to say bad things, right? Like we never want to really highlight something bad that happened in an experience with somebody, and we have this tendency to be more conformative. And it's an art to draw it out of them. And I think there's a fair balance of things that are said and that are not said, and reading between the lines becomes more and more important. So if, for example, you ask a direct question about what could be some areas of development for this founder, or tell us about a time when you gave feedback to this founder and they took it well or they did not take it well, and they're not really able to come up with these answers and give you actual incidences or have a plausible conversation around that experience, then either they didn't work closely enough with the founder to have those experiences, which happens quite often, because many times people will give us a sheet of references which are named and well-known and reputed, but may not have worked closely with the founder. And that's never a good practice. We care a lot more about someone who has worked closely with you. Whether they're famous or not is a lot less important, to be candid. So that either that is the case, or they're hiding something and they don't want to share the one bad experience that they have had. The other thing that I do that sometimes flushes it out is sort of pushing them to rank. In all of the PhD students you have advised, where does this founder stand in terms of the percentile, or do they surface in the top 5% of all PhD students you have advised in your entire career? Things like that can push them to sort of help you understand if they're really a top performer and if they're top of mind for that reason. So I would say those things. In terms of having a good weakness, look, I don't think there is a good or a bad weakness. I think anything can be overcome and can be leveraged. So weaknesses and strengths are two sides of the same coin. Any strength taken too far becomes a weakness. And there are areas in which there are ways in which you can leverage your weakness to become a strength. So talk about being lazy, right? If you're lazy and have the right mindset, maybe you spend some energy on automating the workflow so that you don't have to do the same thing over and over again. Maybe you're better at delegating and focusing on the one thing that is really your superpower, because you don't want to be wasting your time and energy doing things that you are not best at, and that there are other people around the team or around the business who can be better at. Right. So I think it's a perspective, and it's also about how you utilize and leverage that quality. I use the word quality because from my perspective, the same thing can be a strength or a weakness depending on how it's used.
That's a perfect answer. And I really like how you frame answering the question about what's your weakness with your strength taken too far to an extreme.
Yeah, I want to add into that kind of what Shubhra already mentioned, is more about what is the action, what is the solution. While first, it's important for people to know their limitation. Nobody's perfect, but once you know your limitation, what is the solution you're thinking? How you want to address that? Some people said, "Oh, I think the weakness I have right now is I'm not very good at like customer facing, and now I need to do better on fundraising. So my plan is trying to recruit people to help me on this. I'll try to find an investor joining the strong who give me good coaching on that, or maybe just providing the solution. I think that's more important than you just try to find a weakness that it's good weakness to have. There's no such thing called good weakness. It's more about you have self-reflection and also be able to recognize what is the limitation and then take action on that. As I said, essentially there's no perfect individual, but there are always perfect team. If you know the limitation of each individual, you're assembling the right people together. In general, as a team, you have everything covered.
That is very interesting. And this is one of the mistakes I made in my startup is I partnered with people who were like me and we were just replicating skill sets and talents. How do you look at team and team structure? And Shubhra, I'd love for you to answer this first. Say you have a team of 4 physicians. There's obviously a lot of replication in skills. How would you look at that team and how do you tease out, okay, can these people grow into different roles or are they all going to fight over CEO or whatever role they deem is the most important?
Yeah, so one of the important things we observe is the interaction between different founders, between co-founders. And this used to be a lot easier to do when they would come into our partner meetings and our boardrooms physically, and we got to observe the body language, we got to observe their interactions with each other. There are subtle cues that you can put up, that you can pick up even in Zoom interactions or even over email, in terms of how they build on each other, how they tag team, how they delegate, distribute work between each other. Do they know what their swim lanes are? How clear are they about those strengths and weaknesses and who's responsible for what? How they encourage each other or cut each other off, or so you can observe those behavioral cues in all kinds of interactions. And 4 physicians in a founding team is a bit much, I would say. I think that's an exaggerated example, probably. But that said, beyond that exaggeration, moderating it that down a little bit, I don't think any particular degree is just a good way to see the skill sets and complementarity of a team. They could be potentially 2 very different individuals with very different sets of experiences. Maybe one of them was a biochemist in their undergrad and really knows the wet bench lab world really well, and the other one was a CS major and is really coding in their free time and developing the algorithms for the business. Maybe one of them is an extrovert and really likes to do brand building, recruiting, managing a team. Maybe another one is an introvert and wants to head the R&D and really stay on top of the latest research that's happening in the space. So I think you really have to peel the onion and go beyond the surface layer of what their resume or their LinkedIn says and have a conversation to understand how they play off of each other and how they build each other up and make the 2 + 2 = 5 as a team. And that can come between people of any 2 different backgrounds or similar backgrounds even. So that is the broader message here, but there is certainly some benefit to having very different skill sets, very different personality styles. Maybe one of them is very enthusiastic and excited and has a lot of energy, and the other one is just calmer and better at handling conflict or difficult situations. And so I really think that this is the hard job of being an investor, and this is where your intuition again comes in, because you're not going to see all those dynamics play out before you write the check, and you have to some degree trust your intuition that they are looking like they would play out in a positive way.
Perfect. That is a really good framework to look at teams at. Lu, do you have anything to add to that?
Yes, I think Shubhra have a very good summary of how to look at the people's different interests. I think for us, we in general just want to see first whether there's a clear guideline of the decision making. So among the team, who gonna be the ultimate decision maker, because it's hard to see there always an agreement within the team. There will be time that someone need to make the hard call and just execute on it. Making quick decisions sometimes even more important than just drag everything to the end that everyone agree with each other. And when that happens, whether there's a clear person, like clear kind of definition, who is the ultimate final decision maker when there's a disagreement, I think that's very important, just very practically from the execution. Another thing is, I think interest probably is more important than the background. Sometimes people may find, and like you said, you may find people with similar background, all from, biomedical degree and also went to the same school. You still want to find people you trust. You think they're top talent to become your co-founder or founding member. But later on, it's really based on everyone's interest. Some people said, okay, my interest is I want to be the external facing person. I want to do fundraising, I want to do customer. Whereas someone said, okay, I want to focus on technology. I think to have that diversity, no conflict is more important than the background. It's harder for you to just find a perfect team at the beginning. You know, this is a perfect business person, that's a perfect CTO. No, but if smart people, you could just learn and grow to the role you want to be. But if sometimes you say, okay, two people, no matter background is the same or not, they all want to become the CEO or CTO eventually, that will cause lots of trouble later on. Remember, 80% of company die because of internal conflict. And you want to try to avoid that to happen by essentially understand everyone's expectation for what they want to do, what role they want to play in the company. Another thing is, go back to what I mentioned, who is the final decision maker, also relate back to the cap table. How much ownership of each person, the final decision maker has to be the one have the biggest share, because that's just the structure to make everyone on the same page that, okay, this person gonna make the final call if there's a big disagreement. Another thing, how to set up a nice option pool to make sure now you defined on divided the share based on the people's past contribution, background, and potential future contribution. But sooner or later, you can see some people exceed the expectation. Some people didn't fulfill what they promised. You wanted to have an option pool, always update the option pool to incentivize the people who continue to contribute and will contribute in the future, and also be able to also make sure it's a fair distribution among the core, funding team.
Is an option pool a must before you invest at the seed stage, or does that come on?
We will help founder set up the option pool. Maybe a founder didn't set it up, it's fine, but we're said, okay, you need to set up certain number of the option pool when we're doing this round.
Okay, I think that's a yes from you as well, Shubhra, from your reaction.
Yeah, a very emphatic yes, especially at the seed stage. Even in the later stages, we'll insist on having an option pool. The one thing a thread I want to pull from what Lu said before was interest over background. I think resonated very well with me, and this is also true in hiring. I think too many people index heavily on prior experience and background. How many years of experience do you have doing exactly the same job? And in today's world where technology is moving so fast, markets are moving so fast, skills become outdated so quickly, your ability to acquire knowledge and skills and continue to train on the job and be on your feet is way more important. What's a better predictor of that? One, have you been able to do that before? How long did it take you, or how well did you perform anytime you had to learn a new skill or transition careers significantly? And secondly, how passionate, how hungry, how interested are you for this particular job to motivate you to do that? Because it's a lift. Every time you switch careers, every time you learn a new skill, there is a certain amount of investment that goes into it. And you have to be willing and motivated and hungry to be able to make that investment. And so I think too many people don't ask those questions when hiring candidates or comparing to prospective hires. And in today's day and age, that has become way more important than did they spend 7 years or 7.5 years doing this exact same job.
Yeah, this is the second mistake I made in my startup is not hiring for commitment. And it is Adam Grant talks about this in his book Originals, and I recommend that book to everyone as well. And he says hire for commitment early on and post growth in the mature stage, at which point most VCs are not involved anymore, then you might need some time. Arshad Faruqi asks, would you fund 2 startups in the same space but have different approaches IP? Shubhra, do you want to answer first?
Sure. It depends on what markets they're servicing. The technology is only one of the many pillars, right? So if they're catering to the same customer base, solving the same problem in the same geography, going after the same market, and it's going to be a bloodbath between them, then no. But if they have developed something which is a very fundamental technological innovation that can be applied across many different industries, across 2 different geographies, across 2 different customer populations and segments, then yes, absolutely. And potentially also gives us a leg up, because hopefully if we have gone deeper on that space, we're very thematic in investing, and we would have studied the technology and the IP landscape quite well. It would potentially help us do our diligence and get to conviction faster on a second company in the same space, as long as we believe that they are not going to be directly competitive for the same dollars.
Lu, I'll add something else to the question as well. Since VC is a game of maximizing upside and the power law contributes towards picking winners and then not worrying too much about your losers, because the maximum you can lose is 1x of your money. What are your thoughts about VCs or investors who portfolio construction partly is we will invest in everything in the space because someone will win and we will catch that winner?
Yes, first, that's not our strategy. It's just that, to be honest, practically it's hard to do so if you're in early stage. I think for bigger VC, if they just do so in the growth stage, the number of the company is within certain range, then you could potentially do that. But for early stage, it's just very hard, because it's like not like we're not talking about hundreds of thousands of companies, probably even more than that. So just not practical. Another thing is, I think it's really about investing in companies, not only just the investment picking, it's also about spending time with founder to grow them. At least that's our approach. We take the lead position, we take the board seats, we help founder go through the whole process. Definitely, I still think the best founder, the best company, they will success without VC money. VC money is more like catalyst to help them grow faster. But on the other side, for this fast changing market, spend valuable time with founder, and also really give them the right resources connection, and to really accelerate in the growth path is critical. If investor gonna invest a ton of company just doing a mathematic play, I didn't really see the value add-on piece really reflect there. And also, what is the true nature of a VC? If you look at the total number of the money in VC industry, is much smaller than pension or endowment or hedge fund. The reason VC is unique is because money is only the tool. Capital is the tool to bring the right connection resources, then we could come in to really become close partner with the founder and their actual, external team member, founding member, to grow the business together. That's the reason, like for us, we are more concentrated. We build a concentrated portfolio for the good company, and company really matching with our focus. We take the lead position and really spend quality time with them.
Perfect. How did you both decide on early stage investing? Why not invest in Series C, Series D, where the risk is less, but the upside is less as well?
Yeah, I could quickly answer that. For me, it was very simple, because I was an entrepreneur. I built and sold my own medical device company to Boston Scientific before I started investing. When I was a founder, I hated VC. Literally, I told many friends, like, oh, I hated VC. Like, there are so many things. I don't understand technology life cycle. But later I'm like, but they're so important to the ecosystem. And this is also opportunity for me to make a change. So I started Fusion Fund. That's the reason, it's not about which part is most, financial return, etc. It's really just purely out from my passion. My passion is early stage. I'm a technologist. I'm a former entrepreneur. I'm still an entrepreneur mindset. So early stage really keep my passion for me to be able to engage and involve with the company when this early on. And that's the reason we continue to do so. Not only me, all the partners recruiting my team, they're all technologists and former entrepreneur.
Perfect. It sounds like you found your ikigai, Lu. Shubhra, how did you decide on early stage?
I would say, just based on what I spend my time on day to day doing, right? Like, I love meeting founders. I love thinking about big problems within the healthcare ecosystem and building products or solutions that would meaningfully change healthcare as it exists today. And all of that happens much more at the early stage investing. I also get to be more closer to the company and the founder and be more involved and part of the company building and business building, which is my number one reason for why I do this. I think we get to live vicariously as builders and operators through our engagement, active engagement with companies, our positions on the board, all of that. Later stage investing is a lot more financial engineering than it is about business building. Again, there is no, it's not black and white, it's not 100 and 0, but it certainly indexes a lot more towards financial engineering. And that is less exciting to me than the company building aspects, which you get to play with more at the earlier stages.
How much importance do you give to a pitch deck? And what is something founders get routinely wrong in a pitch deck, you think?
I can
So
go first. I have some strong opinions on this one. Sorry, Lu, go ahead.
Oh, thank you. Yeah. So for me, I sometimes met founder. I know there's like YC demo day coming up. There's another demo day. There always founder came in, said we don't have a deck. We just want to see conversational. I don't like that. I don't think that's a smart way to talk to investor. I keep telling founder, a pitch deck is not just a simple material to share with investor. It's a way to show your thinking process, how you analyze the market, how you analyze the opportunity, how you identify your technology differentiation. It's not just the content you put in the deck. It's really showing how you really understand the whole opportunity. So having pitch deck is actually a really good guideline for both founder and investor. So that's the reason I think sometimes when founder came in with no pitch deck, I'm like, did you ever actually really comprehensive think about the opportunity? And also, do you want to share that constructively with the investor? And also within the pitch deck, I think another thing is really think about it from an investor perspective, how to have a really smooth flow. Start with, you have to show big enough market first, and then to show like what is the problem, existing solution, how you solve it, differentiation, market landscape. Just thinking about pretend you're hearing someone pitch to you. What is your question? One after another. Follow that flow to design your slide deck, and then the conversation with investor will be more smooth. Sometimes founder definitely complain, okay, we got interacted by investor one after another. But if you were able to create a flow that whenever investor asks a question, you're like, perfect timing, next slide it is. That's actually create a very good momentum between the conversation.
Perfect. Shubhra, I'd love to hear your thoughts on this as well.
Yeah, I'll answer the second one first, which is one of the most common mistakes that I see people make. Too many founders put the team slide at the very end of the deck and wait to get to that. It's almost like walking into a meeting with someone, talking to them for 30 minutes, and at the end of 30 minutes, extending your hand out for a handshake and telling them your name. How weird would that be? So we have no idea who we are talking to, unless, of course, that information has been shared before through some other context, then that's different. So introduce yourself, introduce the problem or the opportunity you're working on. I often spend the first 15 minutes of the meeting trying to figure out what the business does. I'm just guessing the entire time and really waiting for the founder to get to that slide. So just frame the contexts. Who are you? What are you building? What problem you're solving? And then, as Lu said, why should I be interested? How big is this market? What is the market opportunity here, really? Start there, and then you can go into the nitty-gritty of the technology and the why you're differentiated and all of that. How important is it to have a pitch deck? You wouldn't talk to a German-speaking person in French if they didn't understand French, right? Like, so you have to talk to people in the language that they are most familiar with, in the language that is their first language, even if they know other languages, if you really want them to understand your point and engage with you in a meaningful manner. And so fundraising is already hard. Don't create more friction unnecessarily for yourself. So if that's a common standard practice, most of the industry responds well to that. Focus on things where you truly are differentiated rather than trying to create additional layers of friction by just trying to go beyond the usual.
I agree. I think this is one place where too much creativity can be harmful. And there's a big disconnect, I believe, because founders are like, well, investors, if you're interested, you should talk to me. But I'm very new in this space, and even I'm getting 1 to 2 founders reaching out to me a day. So I can't imagine the inbound deal flow you guys get. And it's just not, you can't talk to everyone. Or that's all you would be doing your whole time, and you would not be doing anything else.
It's not in their interest either. if we know that we're not a good fit, then do they really, I mean, founders already are overwhelmed by the number of investors they are talking to, and most of them don't like it. Lu's not the only one, I'm sure. So it's not what they became founders for. They would rather focus their energy on building the business. So if it's not a good fit, wouldn't you rather find out sooner than later?
Yeah, I think that's well said. Let's talk about, sorry, go ahead, Lu.
Richard, I don't know why. Actually, on my calendar it was blocked for 1 hour, so I do have a meeting starting 5 minutes ago already. But seems like you will continue conversation. So I wonder what I could leave for now. Are you gonna extend it? How long is the session?
I think it's 24 minutes more.
Oh,
But yeah, we'll do more for sure.
okay, great. Thank you very much. And Shubhra, it's really great to share the stage with you, and so glad to meet all this like investor and founder in this community. Thank you very much for having me.
Thanks for coming, Lu. Next question I wanted to ask was, tell me about a good competitive advantage. I think this is something founders struggle with quite a bit, is how do I differentiate myself? So what's an example of a founder you came across or a company you invested in that had a really good competitive advantage? Was it network effects? Was it they just had a great network to sell into? They had a great distribution strategy? Or what are some examples? And what are some examples of a bad competitive advantage? Like if you saw this on a slide, it'd be like, this is not.
So of course, there is no one or two in each of these categories, right? Like your competitive advantage is very unique to who you are as a team, what business you're building, and what market you're operating in. A competitive advantage in US may not be the same, have the same degree of differentiation and moat in a different market, right? Like, so let me first start with that caveat. I'll share some examples in each category. I'll start with the bad ones. Sometimes the only competitive advantage people will have is cost. So a price. We are just the cheapest one available in the market. We're building the exact same thing, but every other player is 2x more expensive or 3x more expensive. Now, cost can be a competitive advantage. Price can be a competitive advantage in very few situations, and by a huge multitude of margin. If it's several orders of magnitude, then yes, it can be a competitive advantage. And if it's sustainable, then it can be a competitive advantage. If it's difficult to achieve, then it can be a competitive advantage. So if you're a B2B business with very long sales cycles, for example, in healthcare, if you're selling to payers, and your reimbursement levels that you have been able to achieve with them are just out of the charts. So nobody else has been able to get the same degree of reimbursement for the same service with a contracted major national payer. And these are 5-year-long contracts that are auto-renewing every year. Now that could be a sustainable competitive advantage on price. If you are selling something that is direct to consumer, and just because your supply chain is a little bit better and you're able to offer at $20 a piece versus $30 a piece from one of your competitors, how long is it going to take them to catch up with you, and how long are you going to be able to sustain that competitive advantage, and how many consumers are really going to be swayed in their choice by that small price difference, right? So I think that could be a very weak competitive advantage. In terms of great competitive advantages, technology or IP often ends up being a very good, sustainable, and defensible competitive advantage, which can persist over time if you especially have done a very good job on your IP strategy, both defensively and offensively, and have secured the landscape of patents for your current and future product development, and really own that landscape. Then that is a very good downside hedge for investors, and a very good upside opportunity for you to expand into additional markets beyond what you're currently selling. Other examples of great competitive advantages are, of course, proprietary access to data. Now that we're seeing a lot of businesses that are being built on data and machine learning. And so if you have access to a proprietary data set that you have either generated or acquired or are in partnership with somebody who has access to this treasure trove of data, and you are able to gain access to newer, refreshed, updated, latest data elements there, which other people may struggle to get access to, or you've obtained some kind of exclusivity on that arrangement, then that can be a very good competitive advantage. It can give you at least sufficient time to build a scalable business and be first to market and get sufficient foothold in your customer base before somebody else starts to catch up. Team and talent is always a great competitive advantage. What is your unique insight, understanding of the market, either through personal lived experience or through professional background and training that nobody else can replicate? How have you built a unique bench of talent in your executive team, which is very difficult for somebody to acquire and replicate tomorrow? So that can be a pretty good and sustainable competitive advantage. I'll take a pause there.
Perfect. That is a very thorough answer, and I think it will help our founders quite a bit. Oftentimes, I hear from founders, my competitive advantage is I just don't give up, or something more personal, which is commendable, but everyone will say that. I think something more objective like IP or distribution strategy is a better competitive advantage. I do worry about Chat GPT in this realm where the lack of IP in the new startups is troubling. Is that something you've seen with generative AI and AI being a commodity now, and perhaps coding be a commodity?
I think access to data becomes more important in that world. It's less about IP and it's less about your coding horsepower. It's a lot more, though, even though the task of coding may become a commodity, the thinking aspect of it, the architecture, the thought process that goes into building a really solid software product is not going to be automated anytime soon. And so I think that's where the talent comes in terms of laying it out correctly, understanding what kind of data you need access to, getting access to those data resources, securing and obtaining some kind of a exclusivity or advantage around that, being able to establish very operationally effective and efficient processes to categorize that data, annotate, label that data, clean up that data, integrate various data sources. All of that is where your competitive advantage is going to come from in that day and age.
Data scientists will be the new software engineers in terms of demand. I'll ask
Yeah, I definitely think that data scientists will become more and more valuable. Machine learning engineers will as well, architects will as well. So software engineers is a very big bucket, right? Like if we're just talking about developers, it's a little bit different from other people who are also involved in the overall process of building a good software product.
Yeah, I'll ask Didi's question. What aspects of due diligence do you think that you're best at, and how did you develop those strengths? And which diligence areas do you wish your firm had more expertise in so they could better support your work?
That's a very interesting question. It's also a very personal one. I would say just having spent my entire career in healthcare and having seen it from many different perspectives, as a physician, as an operator, building product, selling to hospital systems, as an investor, I would say I am faster than most people, if not better, at grasping the nuances of problems and markets within the healthcare ecosystem. Is this really a pain point, or is this a hammer looking for a nail? Is this how much willingness to pay will there be? What will be the barriers to adoption amongst the clinical user base? How will this need to be integrated in their current workflow? These are questions that I'm able to get to and at least ask often, understand, even without asking, relatively quickly, and that really helps in being more efficient in screening and sourcing and diligencing opportunities, certainly. The second is more of a personality aspect. I would say I connect with people relatively easily and quickly. And so when connecting with teams, trying to understand co-founder dynamics, understand the complementarity of various executive team members, the bench of talent, that comes relatively intuitively and easily to me. Areas where we could do better. We're a very small team and could certainly use more resources maybe on the market and competitive analysis side of things. Oftentimes we're Googling around or using the more standard PitchBook and CB Insights to figure out who may be other players operating in this space. And one way to get around that is we have figured out over time that if I am, which I am, very thematic in my investment strategy, and I do the work upfront to understand the spaces that I want to be investing in, I can be a little bit ahead before I see a particular business opportunity. I hopefully already have at least a straw man understanding of the landscape they're operating in and who are the various players in the ecosystem, and that certainly helps me get a head start. I think we could probably do more on the analytical side of that and have more support and resources to do that in a more comprehensive and faster way when we're actually looking at a deal.
Talking about physician burnout and healthcare workforce burnout, there's a lot of startups working on this, but I haven't seen a sticky business model here. As usually, we might be happier, but we're not driving more revenue or decreasing costs. What are your thoughts on that? And have you seen something tangible where there's a profitable business model while reducing burnout?
I think the advent of AI and generative AI and integration of voice will significantly help this. And we're seeing some of these innovations like nuance for scribing for physicians, I think is a major one that has reasonably significant market share already on this. I think whatever enables us to operate at the top of our license, right? Like what are the skills that are unique to us and that have been very difficult and to acquire with us having gone through medical schools and residencies and fellowships, and how do we focus on using those unique skill sets and that very distinguished bench of knowledge over doing administrative tasks that could potentially be delegated, automated, or offshored. And we are certainly getting there with some of these productivity tools, like scribing or medical coding or prior auth. We are seeing a lot of conversation happening right now around disruption of prior auth, right? Like that takes a lot of our time as physicians. So we are going there. Healthcare is a little bit of a slower industry to adopt those technologies sometimes, and for good reason. But I think it's a matter of matter of when and not if.
Do you have anything else to add, Shubhra? Anything else you want to tell our audience today?
No, I think this has been a great session. It was really a privilege to share the stage with Lu. And as I have said before, you're really good at getting to the heart of things and peeling back the layers. So thank you for having me. And I have really enjoyed sharing my experience and insights with the audience today.
Thank you, Shubhra. Thank you for being here today. And a recording will be available for everyone. Thank you, Shubhra.
Thank you, Rashad.